Financial statement analysis helps business owners to understand how to analyze data in financial statements. And the financial statements we're going to consider are three. We have the income statement, which is also called the trading profit and loss account. We have the balance sheet, which is called the statement of the financial position. It gives what the institution, organization has as at that particular moment. And we also have the cash flow statements. So these will help us give us a better understanding of the key factors that will help ultimate decision making. So we're going to look at the financial tools, which include horizontal analysis. We'll not look at trend analysis, but we'll look at the comparative financial statement analysis, which includes the vertical and the horizontal. We'll also look at the ratio analysis finally, which has a number of formulas. So what is the horizontal analysis and what is it all about? Horizontal moves like this. Vertical moves like that. So for horizontal, we use the changes in one quarter amount to the other. But we need to identify the base year or the young year. So if you're looking at 2 years, for instance, 2017 and 2016, subtract the 2017 minus 2016, the difference is this one here. Then divided by the 2016, the younger year. So 1,500 over 16,000 times 100. So meaning there is an increase of 9.5%. Are we together? So we are dealing with our horizontal analysis on sales. If we're dealing our horizontal analysis of our net income, which is a net profit, we can subtract 2017 minus 2016. So here what is happening? We're getting a negative 64. This negative 64 we divide by 3,205. So here we're getting negative 2%. So what I'm trying to say here is that you can get a positive or a negative. If it's a negative, we call it a decrease. If it's a positive, we call it an increase. So this is the simplest analysis on the horizontal perspective that you can give. So you can say that our sales here improved in 2017 by 9.5%. However, our net income declined by 2%. That is a comparative analysis. So if we're to go to our assignment, so we have our statement of the financial position, which we use in acronyms SOFP. And we also have our statement of profit or loss and the other comprehensive income statement. Okay, statement of the comprehensive income statement. We denote it as SOCI. This is also called the profit and loss account. So how do we find, in terms of revenue, our analysis? So our revenue is also called the sales. This is 2018 and this is 2017. Can somebody tell me what we do? We subtract 2018 minus 2017. We get our answer A. Then the difference, we divide it by what? Which of the years, 2017 or 2018? The difference we divided by what?
2017.
2017, the younger year. So you do the same for all these individual statements. So that's what we're doing here. All right. So I started with the statement of the financial position or the balance sheet. 2018 minus 2017, we subtract them. I go to a negative. To get this one here, I divided by the 2017 figure. So the percentage change is negative 1.2%. I went here the intangible assets. 367 minus 396, we're also getting a negative 29, divided by the 2017, which is negative 7.3. So you do the same for all the individual entities so that you are able to see our differences. So when you're done with this, you go back to the consolidated statement, which is our income statement. the sales, we also got the revenue. 60, 982 minus 95, 345, we get negative 34,000. Divided by 95,000, we get negative 36.042%. So I did this also using weight. So this is the same. So these are the differences that we found. All right. So I just want you to get the concept of how to do the horizontal analysis. Unless there's anyone behind, please ask. Is there anyone behind at this point?
Okay, so where I'm a little bit confused where we use the total assets figure to divide all the.
Now,
is it in the
that is the next one I'm looking at. That is now called the vertical.
Okay.
So here we're only dealing with the horizontal. Don't go ahead of us. So to move step by step. So on what I've discussed, what I've explained, are we all on the same page?
Yes, sir.
Right. So now go back to our notes because I want you to understand everything. Trend, I'll not look at it because it looks at patterns. I'll go to the vertical analysis. So the vertical analysis simply shows the relationship of each of the items in the financial statements with a specified base. Now you need to know the base for each of the statements. If we're dealing with our statement of the comprehensive statement, we use the sales or the turnover or the revenue. It's the same thing. If you're looking at the balance sheet, which is also the statement of the financial position, our base are the total assets. So meaning we're going to divide like this. So where there is sales, we're going to have 100%. Where there is the total assets, we're going to have 100% because we're dividing by itself. So an example here is this statement here. We have comprehensive income statement. So we're moving along here. So in 2017, our base will be the revenue here. So we're going to divide 496 divided by 496, 349 divided by 496. So this guy will divide into each of the elements in the whole entire statement times 100. So meaning I prepare from 100%. So when you go inside, you see 100% here, here to be 69%. How did we get the 69%? Because it was 345 divided by 496 times 100. That's how we got 69%. And here, how do we get the 150 divided by? So we get 30%. All right. So this is how the horizontal and the vertical analysis happens because we're moving up and down based on the sales. Similarly, even in the 2015, our sales will divide into each of them. So 518 divided by 518 times 100 is 100%. And we go to 518, this one, 370 divided by 518 times 100%, we get a figure there. So it divides into all these individual elements. We're going to get the percentages of each of these individual elements based on the base, which is called revenue. Are we together? Is that clear? So this is when you're dealing with the comprehensive statement or the trading profit and loss account. So when we go to our assignment using the vertical analysis, we're going to take note of of our sales. So if I take you here, let me start with our income statement. So I'm going to use the revenues here. I'll divide this figure here. 60,000 over 60,000 times 100 is 100%. Negative 78,000 over 60,000 times 100, we get negative 129%. So this guy will divide into all of them in this statement. So if I take you back to ZCCM question, it had 60,000 as our revenue. So you need to know where each of these ones fall under. So our revenue is 60,000. So it was dividing into all the individual elements in here. That is how we're getting the percentages. So you need to know which base it is that you're using. Then when we go to the other book, which is our balance sheet, we'll be using the base. Who remembers the base for the balance sheet? What do we use for the base? We use the total assets. Yes, we use the total assets figure. Go here, and you're not sure to not there, but we use the total assets. So in our case, when we go here, we need to identify our total assets. So our total assets are categorical here. So these are the total assets we're going to use. So to divide in all the figures just in the balance sheet. So if I'm going to take you through, you will discover that 100% will emanate from the what? From the total assets figure. So here, I identify the total assets, they're here. So 100% will come from here. So 10,000 into 1,000 times 100, we get 15%. 10,000 into 339, we get 3%. So 10,000 will divide into all of them. Again, 10,000 downwards. So we have 1,608 divided by 10,333 times 100. We get 0.02%. So in short, we're dividing all the figures divided by 10,000 times 100. So we get all the percentages. Similarly, even in the other year, this is our base. Our base meaning it's the divider. It will divide into each of these ones. You divide into each of these ones. So are there any questions at this point on the vertical analysis? Yes, there's a question.
Yes, I have a question. Revenue less cost of sales is equal to gross profit. The cost of sales figure is not a negative. However, when computing, we're treating it as a negative value. Is it a negative value or is it reflecting the revenue that we are doing with? So you treat it as a negative or positive?
You're not very audible. Kindly try to speak up.
Let me just study.
Okay, anyone with a question while she's working on her mic?
Yes, can you hear me?
Yes.
Okay, so what I was saying is that revenue minus cost of sales is equals to the gross profit. However, the cost of sales figure is not a negative figure. We are just lessing it from the revenue.
Yes.
But when doing the computations, you're treating it as a negative value.
So we're in here?
Right there. So you're saying negative 78,469. So when it's coming from the statement, it's only being negative because it's being lessened from the revenue to get the gross profit. So are you supposed to treat it as a negative value or a positive one?
Okay, that's a very good question. So our gross profit is given by revenue minus the cost of sales. So whether I kept it positive here and positive there, all right, as long as I'm being uniform, I like your analysis. Okay, the difference simply here is that our (2018) figure is 78,000 and 2017 is 100. So the key thing is whether I remove the brackets there, this is still bigger than that. We're getting a negative. All right. I don't know whether you're getting me. I get your consent. So even if we remove the negatives there, because these negatives are just part of the operation of the computations. So even if I remove there, so 78 minus 109 gives me a negative 31. All right. The negative would have been here. So negative 31 over 109 will give me negative 29. It's just an operation of mathematics there. I don't know whether you're getting what I'm trying to say.
I do understand what you're saying, so I'm just trying to verify on my end, but please proceed. I think you've answered my question.
Thank you for that very valid observation. So I repeat, others may not get it, but this negative is just part of the fact that it's a formula, this minus that, but the cost of sales are positive in their own true nature. So even if I were to remove these negatives here, I will get 78 minus 109 to give me negative 31. So negative 31 divided by 109 times 100 to give me negative 29%. Okay, so if I were to go to the way I did it manually here, I didn't put the negatives there. You can see that because I know these ones are what? Are positives. So this is what? 31,392. So when I divide, when I subtract this minus that, it's actually negative 31,392. So when I divide negative 31,392 over 109, I'm getting 28.59%. It's the same. Am I clear?
Yes, so I guess the same holds true with the gross profit amount, because the gross profit amount is a negative initially.
Yes, here.
They recorded negative.
So if you're
So
going to look at, if you're going to look at the way I did it here, it is the same. Yeah, except that I was getting the income statement as it was appearing there with the same signs, but this is a true picture of what is actually happening. So the gross profit is negative. So in their negative ways, when I subtract them, we're getting a negative 29,000 over negative 14. So meaning the answer here becomes a positive because both of them are negatives. All right. Thank you so much. Can we proceed?
Yes, please.
So now we go to another most tedious and most important part of the analysis, which is called ratio analysis. Ratio analysis looks at the 5 categories that so ratio analysis takes note of 5 key ratios of consideration. We have what is called the profitability ratio, the liquidity ratio, the leverage ratio, the activity ratio, and the shareholders ratios. So who are the custodians of the profitability ratios? The managers. The managers want to measure profitability of a business based on the sales and investments on behalf of the shareholders. So they give account to the board of directors to say we made so much profit. And as such, it is important for us to understand the profitability ratios. We have 4 examples of profitability ratios. We have the gross profit margin, we have the net profit margin, we have the operating profit margin. We also have the return on equity and return on capital employed. Sometimes the examiner will specify which ones they want you to look at. I'll discuss them in depth later on. Then we go to liquidity ratios. This one, we have other custodians of information who are called the creditors. They want to know to what extent the firm is able to service its immediate or the current obligations. So a creditor would want to know your liquidity. By so saying, they would want to check in whether, should there be a problem, you have enough assets on you to pay them out or pay them off. So we have 3 ratios under the liquidity ratio. We have what we call the current ratio, what we call the quick ratio, and we have what we call cash ratio. We also have leverage, which goes to our creditors, the banks. They want to know the extent to which we are financed by debt relative to our assets. The more we are leveraged, it means we are financed by debt. It is dangerous if an institution has too much debt and less assets. Managers, again, in the sales department, are accountable for the assets that they have, the fixed and the current assets, in the way they are generating their revenues. So efficiency looks at how well the company is using its assets. If you have minibuses, how well are you using these minibuses to producing what? Sales. If you work on Majando, activity ratio is very important. The condition of the buses and how they are servicing your revenues. And also the investors, these ones are looking at the performance of their shares, because these shares are the ones that are key indicators to seeing how well the company is performing. Potential investors too would want to see your performance. Even banks would also want to know. So now I gave examples of profitability ratios. We have the gross profit margin, operating profit margin, the net profit margin, or the return on sales. Under the liquidity ratios, we have the current, the quick ratio, which is also called the acid test ratio. We also have the cash ratio. Under leverage, we have the debt to equity ratio. We have the debt to asset ratio as well, and the interest cover, which helps us calculate what is called the TIE, the time interest end, which bankers are so much interested in. Then also, we also have the activity ratios, where we have the debtors days. Debtors days give us a picture of how long our debtors take to pay us. If they take very short, well and good, we are more liquid, we don't borrow, they have paid us for the sales we made on credit. The credit days also looks at how long we take to pay our creditors. They supplied us on credit, and so we also need to take consideration. So sometimes on the creditor, in our analysis and interpretation, you need to balance and know if we took too long, it is a problem. If we took too early, it is also a problem, because we can't always justify paying debt in the quickest possible when you need money. Then you want to borrow at an interest from the banks. So this also gives us a picture of the prudence of the sales department and finance department in how they're servicing what? Their loans. Then we also have stock days, which give us a picture of how long it takes for us to keep or to restock our inventory.
Mr. Collins.
Yes, please.
Good afternoon.
Good afternoon.
Fine, thank you. I kindly wanted to ask,
Yes.
is it possible for you to share the video with us afterwards the way you usually do it?
Yes, I'll share.
Thank you. Okay, then I'm logging off.
All
My
right.
lunch is over. We'll watch the video. Thank you very much.
All right. So, so the stock days will give us indicators of how efficient we are. It is important to note that sometimes when we keep stock for a long time, it attracts other costs. Costs like storage, costs that attract theft, costs also that will attract security costs, carrying costs or handling costs. So it is important that we dispose of our stock in the acceptable period of time. Also, selling too much stock is dangerous. If you are always wiping out stock, such that certain members of the society who we call customers will never find stock, they will be demoralized. For instance, you discover that there are certain booths that are overperforming to an extent that you never find what? Cash or float. So it also becomes a problem, which you call a stock out cost. This stock out cost is a cost that loses customers for the business, especially in the sense that most of the customers will never find stock, will be discouraged. Then finally, we have the investor ratios, where we look at the earnings per share, the dividend yield, the market capitalization, the return on total assets, and the return on total equity. You discover that some of these ratios can also fall in the profitability ratios. Some of the books will show you them following there, but they're the same, because this is a mini board. Well, somebody had asked me yesterday to say, where do shareholders fall? I gave my personal opinion to say there could be an intersection, because some of them may be in the board of directors representing a chunk of the directors, of the shareholders, but some books who add these ones there, some put them there, but it's the same concept of the formulas. So each of these ones are formulas which we'll talk about in the next class and apply them to our assignment. Unless there are any questions, we'll end here for now.